The US just lost 92,000 jobs. Normally that would be a great news for crypto. Lower growth means the Fed cuts rate. Money flows into risk assets, but Bitcoin still dropped anyway. And while all of that was happening, a regulator in Dubai quietly told one of the world's biggest exchanges to pack up and leave. Today, we're going to break down why all three walls hit at the same time. Today, we're going to walk through exactly what's applying pressure on Bitcoin right now. Let me give you the market picture first, because everything else today makes more sense with this context in mind. On the 4 hours chart, Bitcoin is sitting at around 67.7K. Since early February, it's been printing lower highs under a clear descending trend line. It pushed towards 74,000, failed, and has been grinding lower ever since. That trend line is still capping every recovery attempt. Now here's where it gets more specific. Total open interest, meaning the total value of all active leverage bets on Bitcoin, sits at 44.81 billion across all exchanges, but it drops 3% in the last 24 hours. On CME, where institutional and professional traders predominantly operate, open interest fell 7.74% in a single day. Large players are closing positions, not opening new ones. Funding rates are slightly negative, around minus 0.0006%. Funding rate is a small periodic fees between future traders. When it's positive, long pays shorts, meaning the market is crowded with people betting price to go up. When it flips negative like now, shorts pay longs. The aggressive bullish crowding has already been flushed out. The liquidation data confirms it. In the past 24 hours, 292 million in positions were forcibly closed. Of that, 244 million were long positions, meaning that traders who was betting the price going up got wiped out. Bitcoin alone accounted for nearly 119 million of that, close to 99,000 traders liquidated in a single day. On the heat map, there's a dense concentration of liquidation liquidity sitting between 70,000 and 72,000 above current price. That's where a large cluster of stop orders would concentrate if price move up sharply. Below the next significant pool appears around 66,000. Bitcoin is sitting right between those two zones. And then there are the ETFs. Spot Bitcoin ETF saw 348.9 million in net outflows on March 6, the second consecutive outflow days. BlackRock's IBIT, the largest Bitcoin ETF in the world, shed 143.5 million in a single session. Market environment conclusion is that leverage is calming down, long pressure has been flushed, and institutional flows are moving away. Now that creates a setup where move can get sharp in either direction, especially when macro news keeps landing on top of it. So why is all this happening at the same time? Because today, three separate pressure systems collide on Bitcoin simultaneously. Wall number one, the oil and geopolitical shock. There's an active war in the Middle East right now. US and Israel strikes on Iran disrupted oil shipments to the Strait of Hormuz, a checkpoint that carries roughly 20% of the world's oil supply. WTI crude climbed above $83 a barrel, up more than 5% in 24 hours. And when oil spike, investor gets nervous about inflation coming back. And nervous investors move money out of risk assets like crypto and into safe ones. Now wall number two, the Fed is stuck. The US lost 92,000 jobs in February. That's much worse than expected gains of 59,000. Unemployment tick up 4.4%. Now normally weak job data is actually good news for risk assets like crypto because it means the Fed has a reason to cut interest rate. Cheaper borrowing, more money flowing into the market. But here's the problem. Lower rates help when inflation is under control. And right now, oil is spiking because of the Iran conflict, which could push inflation right back up. So the Fed is pretty much stuck. They can't easily cut when energy prices are climbing, and markets were already pricing a 95% chance of no rate cut at the next Fed meeting in March. And this wall is pretty much the one mechanism that could have supported Bitcoin when it's frozen. Wall number three, and this one might surprise you, the institutional money. When Bitcoin spot ETFs launched, the story was patient institutional money is finally in crypto. Well, look at the last 2 days in the data. Minus 227.9 million on March 5th, then minus 348.9 million on March 6th. 2 consecutive outflow days totaling nearly 577 million. BlackRock's IBIT, the world's largest Bitcoin ETF, pulled 143.5 million in a single session. So the question is, what does it mean when the so-called patient money stops being patient? It doesn't mean institutions are abandoning Bitcoin permanently, but when macro condition gets uncomfortable, such as oil going up, Fed frozen, geopolitical fear elevated, and even large holder reduced exposure to managed risk, and when ETF outflows stack on top of already negative funding and 292 million in liquidations, there simply aren't enough buyers stepping in to hold the price up. So these are the three walls that we're looking at. Now here's the story that barely made the big headlines, but I think it deserved real airtime. While all of that was playing out in the charts, a regulator in Dubai issued a cease and desist order against KuCoin. And if you think that's just a KuCoin problem, stay with me, because it's a lot bigger than one exchange. Let me explain this from scratch. Dubai has a crypto regulator called VARA, the Virtual Assets Regulatory Authority. They were set up specifically to oversee crypto businesses operating in or from Dubai. On March 5th, VARA publicly named 4 corporate entities all operating under the KuCoin brand and told them, stop offering services to Dubai residents immediately because you do not hold a license from it. The statement was direct. KuCoin had been providing services to Dubai residents while, according to VARA, misrepresenting its license status. In other words, the exchange may have implied it had approvals, but it didn't actually have. But here's what's making this bigger than just Dubai shutting out one exchange. This is the second major jurisdiction to act against KuCoin within weeks. Just before this, Austria's financial regulator halted KuCoin's European arm from onboarding new clients. 2 regulators, 2 continents, same month. Now that's a pattern, not a coincidence. And according to reports, Bahrain, Saudi Arabia, and Qatar often follows the UAE's regulatory leads on crypto. So what Dubai does here could ripple across the entire Gulf region. So here's the bigger picture. Dubai spent years making itself as one of the world's most crypto-friendly jurisdiction. Exchanges flock there, projects set up regional offices there, but crypto-friendly was never the same as no rules. VARA has now made clear the framework exists. If I had to describe what today actually feels like, it's not a crash. 3 macro walls squeezing Bitcoin from the outside, while regulators quietly tightened the infrastructure from the inside. The job data was actually weak, which under normal conditions would be a tailwind for crypto. But the Iran conflict and the oil spike changed the equation, and now the Fed is stuck in a situation where cutting rates could make inflation worse. Now that's the nuance most people miss when they see the price drop and simply say that the macro is looking bad. Alright, that's what I have for you guys today, and if you feel like I missed anything, feel free to drop a comment, and if you found this video helpful, make sure to drop a like and subscribe. I'll see you in the next one.